Good afternoon and welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I am Bamakshi Doria and with me is Vivek Iyer. Good afternoon to you, Vivek. Actually, right now the Nifty has managed to slip below the 25,000 mark, but the broader end of the markets is doing quite well.
That's right. Good afternoon, Bamakshi. The story of the last half hour has been the telecom stocks. So both Vodafone as well as Indus are under significant pressure. But we'll move on the show, discuss that maybe a little later on. Let's start off with the top headlines. Stocks see range trade as the market digests positive and negative global as well as local cues. Realty and PSU banks are the big gainers, while IT has been the big drag. Different stocks take a breather, mid-caps outperform.
Graphite India and HEG climb after major Japanese graphite electrode manufacturer Resonac halts production in China and Malaysia.
Protein eGov tanks 20% in trade after it informs the exchanges that it has not been considered for the next round of the selection process for the PAN 2.0 project by the Income Tax Department.
Delivery reports a strong quarter with significantly higher margins riding on strong volume growth in part truckloads business even as the express parcel vertical sees a slowdown.
Credit access slips more than 6% in trade on the back of Q4 numbers. Dispersals come down nearly 20% on a year-on-year basis. Net profit declines 88% from a year ago.
Well, the markets have been flip-flopping between the red and the green. For now, the Nifty has slipped in the red. It is down nearly 30 points, marginally lower. But the mid-cap end of the market is looking quite vibrant. As of now, the mid-cap index is seeing an uptick of almost 0.4%. Apart from that, when you look at the small-cap index, that too is holding up quite well. As far as some sectoral indices are concerned, most of them are in the green. Nifty Realty is seeing an uptick of over 2%. Nifty PSU banks especially are also doing quite well. Pull up the charts for PSB, that is Punjab and Sindh Bank. That stock is trading higher by over 5%. Central Bank too seeing a gain of over 5%. IOB, Maharashtra Bank, that is Bank of Maharashtra, as well as UCO Bank, all are seeing gains upwards of 4%. What's not doing too well is the IT pack. Nifty IT has taken a knock in the trading session today, largely led by some mid-cap names. Emphasis is down almost 2%. So is Coforge, down almost 1.6%. And lots of earnings reactions as well, right? When we look at some numbers that came through, there are some stocks that are reacting negatively to their numbers. That includes Bharat Bijli, Mukan, Credit Access too, seeing a downtick of almost 6% in trade today. On the flip side, some good numbers coming in from KRBL, Divis Labs, as well as EIH Associates. Vivek, the screen as of now in the mid-cap space looks quite vibrant.
That's right. Vamakshi, we'll not waste any more time. What we'll do is we'll go to the first management of the show, Premier Energies. Remember, company saw very, very strong FY25. But the question that lies on most investors' minds is whether this particular performance can sustain in FY26. The company, remember, has also given a very strong guidance in terms of capacity addition for FY26 till FY28. So joining us now is actually the management, Vinay Rastogi, Chief Business Officer at Premier Energy, joins us now. Thank you so much, Vinay, for joining us. First up, FY26, very, very strong year for you. As far as FY26 is concerned, give us a sense of where do you expect to end the year in terms of order book. So what will be the order inflows for the year? What is the guidance in terms of top line, EBITDA margins, as well as PAT? On a year-on-year basis, I believe EBITDA margins almost doubled for you.
Well, to start with, Vivek, thank you for having me. You're right, we've had a very good year. In terms of outlook over the next year, so we already have an order book of about 8,300 crores. Close to 5.3 gigawatt, which is all booked out basically for the next 12 to 14 months. So we expect that we should be able to report about a 15-20% kind of uptick in the revenues from what we have seen in the last year, while maintaining our margins at the same levels.
Sure. And, can you help us understand the kind of demand that you're seeing on ground? Hi, Vinay, this is Vamakshi joining in. Is it still strong? And, because players have been indicating that there have been some delays in setting up of solar power, as well as some concerns with regard to land availability. So could you help us understand what is the demand trend on ground looking like?
Sure. So I think, overall, the demand environment looks very, very robust and strong. And when you say that there are some delays in land and transmission, that's correct. But the good thing is that there are multiple segments in the solar sector. So, for example, there is the residential rooftop solar segment, where the government has a target of 1 crore installations. There is a separate segment for agricultural solar or Kusum scheme. And then we have the corporate market. So if you look at across these three or four different markets, inevitably there is slowdown in one segment or the other, but then the other segments are firing at full speed. So overall, we had a bumper year last year in FY25, where we saw a record capacity addition of 24 gigawatts, and we expect this capacity addition demand for solar modules to increase at least about 15 to 20% year on year.
Got that. Vinay, what I want to understand from you is, I believe at the end of FY25, the EBITDA margins came in were northwards of 28.5%. So when you say you will maintain margins at the current levels, is that the range we should work with? And consequently, given the fact that there has been debt reduction, what will be the PAT that you're expecting for FY26? Or if you could help us with the PAT margin, even that works.
Sure. So Vivek, just to be very clear, when I say we don't give out any guidance for future, so I'm only indicating the revenue and EBITDA margin for the next year basis the order book that we already have, which is firm and tied up. So which is in the same kind of pricing and margins that we have maintained in the last year. So on the basis of that, yes, we do expect the EBITDA number or the margin to kind of stay there in the current ballpark. But on the PAT number, unfortunately, I'm not able to give you any guidance based on company policy.
Sure, and help us understand how your order book is also shaping up. How would you divide it in terms of the opportunity in the domestic market as well as the export market?
So, the domestic market is looking very attractive in terms of demand, as I said, because all the four segments we are seeing record demand. So much so that, as a company, we have been focused on meeting domestic demand first before we look at any export markets. Like I said, the government is very, very committed to Make in India. There is more and more the share of domestic modules as a percentage of the total market demand is increasing year on year. So not only is the solar demand going up every year, but the share of domestic market is going up, which means we are seeing a substantial jump in the domestic module volumes being shipped out in the market.
Understood that. Vinay, we get that completely. Will you look at the export market percentage of exports, or especially to the US market, given the fact that realizations there are much higher? That is the first part of the question. The second part of the question is, when you're looking at the capex of close to 1,250 crore, you've mentioned that most of it will be met by internal accruals, but will you require to take on more debt? You have significant capex plans and capacity addition plans for FY28. If you could help us here-wise, what will be the capacity addition?
Yeah. So sure, Vivek. So I think your first question was about the US market, right? So you're right that prices do tend to be much higher and more attractive in the US. Having said that, of course, you also know that there has been a little bit of uncertainty in the last few months in relation to tariffs applicable on Indian exports. And some of these changes, there have been a lot of changes around these tariff rates as well. Equally, we do expect a trade treaty to be announced between India and US, which will have an implication on what is the potential of the US market for Indian manufacturers. So I think for the time being, most customers in the US as well as the Indian module suppliers are being a little bit cautious on the US market. We are waiting for more clarity to emerge, including ourselves. And as and when that clarity is there, we will be ready to make the maximum use of that opportunity. In fact, we do have a plan to set up a manufacturing plant in the US, and we will action it, depending on how the trade discussions evolve.
And is that plant plan, part of the capacity addition that you've given in the presentation?
It is very much so, yes.
So what will be the total size of the plant in the US market?
So the size that we're anticipating right now is 1.2 gigawatts of cell capacity out of the total 10 gigawatt that you see on the screen.
One particular problem that a whole host of players have highlighted, the fact that especially when it comes to the domestic market, there has been significant announcements made by a whole host of major players. So you have names like Reliance, you have names like the Adanis, who are entering the solar cell and module, the entire ecosystem. Going forward, how do you expect realizations to pan out given the tailwind of ADD that is there? And do you expect some moderation as far as realization is concerned, especially when compared to a bumper FY25?
Yeah, so I think that's a very interesting question and is obviously at the top of everybody's mind. What I will say is that one, like I said, demand is increasing. Second, a lot of players have announced an entry into this segment, but this remains a very complex and capital-intensive business. So we have to see how much of these announcements actually get converted into real projects on the ground and capacity and shipment volumes, right? So I think our view is slightly moderated based on what we see on the ground, and we believe that over the next 2 to 3 years, demand supply will remain largely in balance. In future, beyond that, I think it is difficult to foresee how it will play out. But the key thing is again this sector, given some of the dynamics that I just pointed out, the performance will eventually depend on three factors, which is what is the scale of the company's operations, what is the backward integration, and what is the technology adaptation. So I think based on these three parameters, we believe, particularly given the Mission 2028 that we have announced, that we do stand on a very strong footing, and whereby we will be able to maintain our competitive position as well as realizations and margins.
Understood that. Sense of the capacity utilization across the cells and modules facilities. Also, very interestingly, you've announced an entry into BESS, right? So what are you seeing, a slight deviation from what you've been doing? So what kind of returns are you seeing there, especially given the fact that there have been a few tenders of higher rates that have been cancelled in that particular space?
Yes, so Vivek, that's correct. But the fact is that, irrespective of what is happening in these tenders on a short-term basis, demand for storage is very, very strong in India and is going to increase in future because you do need a lot of storage to balance out the intermittency of renewables. There are more and more tenders coming demanding more storage capacity. The government has said that storage has to be mandatorily installed with every solar project to be able to provide more firmness to the grid. So as a result of that, we do see a very attractive demand side environment. And we have announced a foray into this market, scaling up to 12 gigawatt hour over the next 2 years. In terms of margins, we do expect, based on the current market assessment, EBITDA margins of somewhere between 12 to 15%. But that again, will depend on how the market evolves.
Well, thank you so much, Mr. Rastogi, for joining us after your Q4 numbers. We wish you luck for the quarter as well as the year ahead. But that's time for a very short break. Up next, we will be joined by the management of Balmer Lawrie & Co. to discuss their Q4 numbers. Don't go anywhere. Stay tuned. Welcome back. You're watching Midcap Radar on CNBC-TV18. From one management to another then, Balmer Lawrie is the next management on the show. Revenue and EBITDA margin came under pressure. Do note, company is engaged in various businesses of industrial packaging, lubricants, chemicals, logistics and travel services. To discuss more, we are joined by Adeep Nath Pal Chaudhary, who is the chairman and MD at Balmer Lawrie & Co. Well, good afternoon to you, sir. I'd first like to start off by asking you about your outlook for FY26. In the fourth quarter, we understand that the top line has grown by just 5.5% on a year-on-year basis. So what is the kind of growth that you expect in FY26?
Firstly, thank you for having me here. We are having a fairly positive outlook for the current financial year. So the previous year, we ended with around 7% high on turnover and 12% plus on PBT. So we expect the numbers to be stronger in the current financial year, and we are looking at a turnover of something in the neighborhood of 3,000 crores maybe.
Thank you so much, sir, for joining in. So from close to 2,500 crore, we're expecting the top line to grow up to 3,000 crore. What can we expect, will be the corresponding EBITDA margins and PAT? And which segment of the business do you expect will actually go ahead and help drive business forward?
Yeah. So our EBITDA as a percentage, actually, we had an uptick. We did 14.73% this year as compared to 14.16. And however, with the focus on turnover, we may not be able to hold on to that EBITDA, but we are still going to be end up with a good profit figure. Now, the growth primarily are going to come from three fronts. One is the logistics as a cluster. We are having three businesses: logistics services, which is the freight forwarding, logistic infrastructure, as well as a cold chain. So logistics as a cluster, I think, is going to give us the maximum growth. Travel and vacations has been very strong in the last couple of years, expecting good numbers from there as well. And manufacturing, especially industrial packaging and grease and lubricants, should help us round up the figure to the estimate that we are expecting for the current year.
Sure, and you mentioned the logistics services and logistics infra business that will be your growth drivers for FY26. But profitability out here has been quite weak. So, can you help us understand what is the reason behind this? Is it because probably there might be some increased competition out here, which is putting a drag on your margins?
See, there are two separate businesses. One is the logistics infrastructure, where we are actually having these container freight stations, where historically what has happened is that the government has done many kind of initiatives in order to ease of business. And that has actually put, because the focus for the government is in the efficiency of the port ecosystem, and that has put the margins of this particular business under a little pressure. Logistics services, which is freight forwarding, I think at this point of time is going through a little kind of volatility, given the fact that ocean freight has been volatile. Various kind of challenges, like, for example, the war, the tariffs, etc., puts a lot of pressure on the buying of the ocean freight and also air freight, whereas where our customers are mostly contractual. So that is where we are seeing a little pressure, but I think we'll be able to overcome that with new initiatives that we are proposing.
So, one question that a whole host of investors, generally tend to ask us, especially with a large PSU like yourself, is that you actually have quite a large land bank in prime properties, across quite a few major cities as well. FY26, can we see sale of some of these properties? Will you look to unlock value there and thereby, further strengthen the balance sheet?
Now, this has been oft asked question. Right. And the answer to that is that we do not actually have a lot of land bank. Okay. So the question of unlocking value through sale of land assets does not really arise. Not in this financial, probably never ever, because we don't really have too much of a land bank.
Sure, and let's also talk about your greases and lubricants segment. How has that done in FY25? And we've seen that crude prices come off the highs that we saw last year. So will this impact your business out here, and what would it be?
So grease lubricants has been a strong business for us. In the current year, we fell a little short in terms of output as compared to the previous year. That was because we rely a lot on the base stock, base oil, which is our feedstock, and that typically comes from the various oil marketing companies, refineries. So we've had a long shutdown of HPCL and other refineries, which prevented us from sourcing enough of bright stock, which is a key ingredient. In the coming year, we are not anticipating any such shortage, and hence we should be able to do very well. Our profitability in this particular business has significantly improved over the last 2 years. And we expect this business to be a very, very strong business for us, especially if we are able to grow well in the automotive and the bazaar trade.
So one final question from our end. Expected capex outlay, if you could give us even a 3-year plan that works for us, and operating cash flow, how do you expect that to trend over the next couple of years?
Very good question. The capex actually will it's likely to move up significantly in the coming years, not necessarily in this year, because we are making a significant foray in rail logistics. So this year we are going to commission 3 rakes, and that is going to help us take cargo from our contractual customers from the steel plants from the eastern part of the country to the northern part. So that's going to be a fantastic business that we are just getting in. And as we stabilize that business, we are expecting to invest in a big way in rail-related logistics. That could be rakes as well as potentially Gati Shakti cargo terminals. But having said that, the current year, the capex is going to be in the neighborhood of around 200 crores, which also is expected to involve the capex for a large IT project, which would be the S4 HANA migration from where we are right now.
Sure. Thank you so much for that, Mr. Pal Chaudhary. Thank you so much for joining in after your Q4 numbers. That was the management of Balmer Lawrie. The stock as of now is trading with a minor gain of 0.4%. The management said that they have a positive outlook for FY26 and a turnover of almost 3,000 crores is what they're expecting going forward. Now, as we slip into a break, here's some good news for our viewers. India's business news leader is now only a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at just your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen. Welcome back. You're watching Midcap Radar on CNBC TV18. The Nifty continues to be range-bound in trade today. The index is just 25 points short of the 25,000 mark. The midcap index, though, continues to do well, up almost 0.3%. So is the small cap index, up almost a percent or so. Nifty Bank also holding up quite well. But with that, that's all we have on Midcap Radar. From Vivek, me, and everyone who put the show together, big thank you. Don't go anywhere. Your Stocks comes up next.